welcome and good evening, everybody. Welcome to tonight's webinar, Trading Indices. Now, before we get to the actual webinar, as always, please take a moment to read through the risk disclaimer. That should be long enough. Right. So what are we going to discuss today? First of all, we're going to look at, well, me. I'll explain a little bit for the people that are new, who I am, what I do. Then we're going to talk about what indices really are. Let's just very briefly just scan over what they are. Then we'll talk about the four major indices we're going to discuss today. You know, the S&P 500, the FTSE, the German 40, and the Japanese 225. Then we'll look at how you actually go about analyzing an index or an indice, the same thing. And then we're going to go to the chart and we'll approach. I'll show you a little bit how you approached actually opening the trades, and, you know, looking a little bit for entries and how you would day trade this or how you would set up a long-term trade. I'll try to get as many examples in as I can, given the allotted time. And then for those that are in the webinar, we'll have the Q&A afterwards, and then it's, you know, a free-for-all for you guys. This part won't be there in the recording or on YouTube. Okay, so about me. So my name is Mike Rotting, like I said. I live in Athens in Greece, and I've been trading in FX for a little over 15 years. It all kind of started when I was in college in the Netherlands, where I'm originally from. I was studying international business studies, BTech Cambridge program. And, you know, I was looking for something during my time, and I stumbled upon something that is now developed into what is Forex. Like most, first 2-3 years, you know, on and off, obviously young, eager, trying to get as much money as fast as possible and finding the relevant videos for that, finding out that that is not how this works. So after a few stumbles and accounts, I decided to basically throw everything I thought I knew in the trash can and start from scratch and really start learning, you know, the fundamental basics of the trading, step by step, and learning how it differs from professional trading, let's say Goldman Sachs and stuff like that, how retail traders trade, and then looking at how I can combine the two and then get the idea. So that worked for me. Fast forward in 15 years, well, basically 12 years of profitable trading. And that brings me to what do I do? So for the past 6 years, I've now been doing these webinars, like LegacyFX. You know, they request me to do a webinar. I make the content and I provide you these webinars that you're watching now. This is kind of one of my approaches to try and pass on as much of the knowledge that I've built up over my trading career to help you avoid some of the mistakes that I may have made, maybe shed some light on some things that I was maybe also struggling with, or that I know people are struggling with, and maybe just give a little bit of insight. Even if you're a veteran trader, you know, maybe this is just a slightly different way of approaching the same thing that you do, and it might just, you know, be something, hey, I can pick that up or add to my trade or not. So yeah, apart from that, obviously the mentoring comes in the same line as the previous. Still working on my CSI level 1. This is an on and off kind of thing. It's financial advisory. I'm more interested in just getting it for myself, just to get an idea of that market and offshore investments and that kind of thing. Just for myself, because I have offshore investments now, so want to understand a little bit more about that. And then other projects, yeah, basically, you know, as I get requested to help with certain things, usually on a financial investment related platform. Not always, but usually. So that's me in a nutshell. All right then. So what are indices? Indices are also known as an index. So if we look at the financial world, so in Forex, we basically refer to the indices as a statistical measure of changes in a security or market segment. So what that means is that basically, if you dumb it down, like the S&P 500, that's a very broad one. But if you look at, let's say the NASDAQ, which would be, that's the market segment of just the securities that are controlled in basically Silicon Valley, right? So the electronics. There's different indexes like that. There's one for chemical, there's one for medical, there's one for export, but there then is the indices that we are more common with, and that's the the combination ones. Now, why would you have these indices in your portfolio? So why are we looking at adding this to our portfolio next to our majors and commodities and stuff like that? Well, generally speaking, that traders include indices in their trading portfolios because it allows you to trade in the stock market without having that hassle of knowing everything about the stock that you're buying, even if it's a CFD. Right. So if you would directly invest in, let's say you want to do day trading on Google or Apple or Microsoft or Mercedes-Benz or whatever it may be, one of the approaches that you need to do with stock is you need to learn all about the company behind the stock, understand what their financial strategy is, how their business model works, what their CEO is planning, how the board of directors, what their 5-year plan is, how the market is developing around that, and that helps you plan long-term trades. Now, this doesn't affect you as much in the short-term trade, but it should still be something in your back of your mind because it allows you to make judgments in which direction short-term trade should be going, because you know that the pressure is going to be in a certain way, bit more than the other. And when this market flips around, obviously, right? So if their 5-year strategy falls on its ass, you know that this is going to have repercussions of liquidation of assets. So the stock will drop. This is a problem that you will directly be affected by if you are trading a direct stock, right, or a CFD of it. What you don't have this problem with is when we trade these indexes or the indices, right? Because they are a combination of multiple companies together. If one or two has a bad year, it's not going to affect the entire thing as much. It depends on what their ranking is, and we'll get back to that in a minute, because they have a weighing inside these indices. But it is important to understand that if let's say the S&P 500, if number 430 is having a bad year, but the top 5 are having great years, number 450 doesn't matter. They could go bankrupt for all we care. Like, it's not going to affect the indice. It'll just get replaced with another one. It's the higher ones that count. It might give it a little bit of a bad day, but not that bad, right? It's not going to reverse any trends. And we can see this in the indices, and we'll see this in the chart later. They are very consistent in their growth over prolonged periods of time. So this makes a little bit easier to judge how to trade them, because you know what general direction is going to be the beneficial one in the long term. And when you're trying to trade for consistency, which is what always the aim should be, this is very valuable information to know, because you can just bank on the safe bet every time. Right? Then you have that, unless you just pick at a very bad moment where you have like a market crash or anything else, but it still rebounds from that, right? Besides, you have a stop loss anyway, but we'll get back to that later. Right? So this is very simply why you want to have indices. They're very stable in that sense, and they just have general growth. So they create some stability within your portfolio of trades that you mix with other things. Okay, so let's talk about the indices themselves for a bit. So let's start with the S&P 500 or the US 500, whatever you want to call it. Now, first of all, the S&P 500, does anybody have any idea what the S&P stands for? Just curious. Who wants to take a gamble without Googling it? Yeah, Standard & Poor's, exactly. So the Standard & Poor's 500. Now, how that exactly came to be doesn't matter, but that's what the S&P stand for. Just a fun thing. Now, what's important about the S&P 500 is that it has a very, very big depth and diversity within the 500 companies that are in it. And this is why the S&P 500 is actually considered a very good measure of how the US economy is doing. Because you have the top 500 companies, not exactly, but I'll get back to that later. The top 500 companies in the US stuck in this index, if they're doing bad, you can guarantee everybody's doing bad. Because most of these companies are too big to fail kind of thing, right? Most of these companies have grown out of the natural like market fluctuations, and they basically make the market themselves, right? They have their tendrils in so many little things, they generally don't get affected by one or two things going down. So obviously that's completely different for that have SMEs, right? Small, medium enterprises and stuff like that. Obviously, if the market is doing bad or like the pandemic, it's very hard for them. They can switch faster, but they have less means to switch to such an event. Bigger companies take longer to adapt, but they have the funds to do it right the first time and just take the time to do it. Right? This is why an index like this is still strong even when things are bad. Now, weighing. So, like I mentioned before, these companies are weighed. And the way that works in the S&P 500 is something called a free floating capitalization weighting. To make it stupid simple, basically the way you need to see the S&P 500 is that it looks at the market cap of a company. Now, it works a little bit different on different ones, but the S&P weight is basically the company's market cap divided by the total of all market caps within the S&P 500. Right? So if you have one that has 1 billion market capital and you divide that by the 43.6 or whatever billion that's currently, or trillion, that's no billion, that's in the S&P 500 is total market cap, then it gets a ranking based out of that. And that is how their numbers come about and how they climb and decline. Okay, now it's free floating because it's not just market capital. There's also some other factors that come in. And a common misconception is that you automatically enter the S&P 500 if your market capital is in the top 500 companies of the S&P 500 range. It's not. There's actually a voting committee that allows companies in, yes or no. So there is another door you have to get through. And obviously the company has to be publicly listed, first of all. But yeah, so there's that. Now, when we're talking about the S&P 500, and this is going to become clear why we want to mention these, here are, in order, the top companies that are in this S&P 500. On the first spot is Apple, then Microsoft, then Amazon, then Meta, Facebook, then Google, then Tesla, and then Nvidia. Apple has as a ranking the top 6.2%. So if Apple has a bad day, the S&P has a bad day, right? Microsoft is 5.9%, Amazon is 3.9%, and then you get 2.4%, and then less than that, right? So Facebook is only 2.4%, but obviously that has to be adjusted a little bit. I don't think that's been updated since, they had a little bump in the road last week. Okay, so we'll get back to why it's important to know, let's say, the top 3 at least for each of one of these, because it comes to your approach later on. So the FTSE 100, right? It's the Financial Times, the Financial Times Stock Exchange, which you can understand is a corporation between the Financial Times and the stock exchange. That's how this thing came about. So Financial Times was the one ranking and tracking it. It's basically the UK's version of the S&P 500, right? But only 100 companies, UK based. Now, unlike the S&P 500, the UK 100 or the FTSE is considered a bad measure of the UK economy. Would anybody have any idea why that is? Why would the top 100 companies in the UK not be a good representation of the UK economy? Correct, Homan. Anybody else? Yeah, why is the UK 100 not a good representation of the UK economy? Why it does not reflect like the US 500 does? Okay, so the answer was multinationals. No, the stock market doesn't decide this. It's very simple, right? Because the companies that are in the UK 100 are mainly in business outside of the UK. Barely any business in the UK. So obviously, it's not a good measure of the UK economy when you're not operating in the economy. You're operating outside of it. Now, like I said, the most of them are internationally focused, and they are also significantly heavily affected by the exchange rate of the pound, which makes them sensible to fluctuations. So it's a very bad measure that way. The weighing is the same way as the S&P 500. Slightly different calculation. They also have like a price level in there, but it's the same capital kind of idea. Now for the UK 100, in order again, there's Shell, AstraZeneca, HSBC Holdings, which is a bank, Unilever, Diageo, GlaxoSmithKline, British Petrol, and British American Tobacco. Those are the bigger ones. Now, again, remember the top three of those. Okay, the top three is very important to understand. You can take all 4, 5, 6, 7, take the top 10. But the more you take, the harder the next stage is going to be when we get to the chart. Okay, so now we have the German 50 or German 40. There's 50 companies in it, but we call it the German 40. So sometimes you'll see it listed as the DE50. That's because there's only 40 major blue chip companies in it, and there's 10 other ones. Generally speaking, they don't even get mentioned, but they're there. Now, their weighing is slightly different than the free floating one, which means that a part of the calculation you have in free floating is not in the capitalization weighted index. In the capitalization weighted index, it's just straight up what their value is. That decides their rank, period. Right? If you have a market cap of X, then that means you're that rank, period, done. Now again, same story as the UK. The German 50 are not good indicators of, the German economy. Because again, they're mainly multinationals that work outside of its borders. There's, they have obviously a share of business within the borders, but it's so small compared to their entire market cap. If you would want to make it, any of these, you want to make it represent an actual country like the S&P 500, they need to have the majority of their business within the borders. So you could remake the German 40, all right, the DAX or the German 50. You can remake that by recalculating all the capitalization weighings based on just their German business. But nobody's going to do that because it doesn't make any sense, right? So you need to understand this, right? Because a lot of people were using these indexes to look at, oh, well, Germany's doing fine. Look at the DAX. Yeah, that's not how this works. It works for the S&P 500. It doesn't work for the other ones. Well, the Nikkei maybe. We'll get to that. Now, for the DAX, we're talking about Linde, SAP, Siemens, Deutsche Telekom, Merck, Mercedes-Benz, Deutsche Post, and BASF. Don't know who that is, but they're there. So again, just remember the top 3 or 4, right? Write those down for yourself or something. For those that get the recording, you can do it later. And this will come into effect, like I said, in the next stage. Okay, now let's take a look at the last one, the Nikkei. Now, the Nikkei, or the Japanese 225, is a little bit of an oddball. It is extremely volatile compared to the other indexes, where, see, the Nikkei's average deviates from the other indexes with the model, and this shows it really on how normal indexes, the other ones, they kind of grow like a steady exponential rate or a steady percentage every year. Yet the Nikkei is like really fluctuant. Now, for us traders, that's good. That means that you can get, good trades in, right? Volatility is our lifeblood. But generally speaking, you want to use indices to stabilize your portfolio, not add more volatility to it. To give you an example, in 1998, December 29th, this was the biggest jump they've ever recorded. It grew sixfold over the last 10 years because of that jump. And it jumped to 38,000, a little bit more, 915 something, so 39,000. But then by 2009, it was all the way back down to 7,000. I'll show this in the chart later where you can see these jumps. Now, here is where the artificial growth question mark sentence comes from. So since 2013, the Nikkei has kind of been under suspicion that the growth has been manipulated, or it's artificial. Anybody have any idea why that could possibly be? Just blind stab, unless you know. What would have the power to push an index? Well, shareholders. I got a lot of silence. All right, I'll tell you. So since 2017, no, the weightage isn't the problem. It's a price weighted index. That isn't the problem. Now, the economy is kind of growing. The value of money is also not the reason why. That doesn't make an index grow. Here's the reason why the artificial growth is kind of being questioned right now. As of 2017, the Bank of Japan owned 75% of all ETFs in the 225, making them a top 10 shareholder of 90% of the companies in the 225. So basically, the Bank of Japan owns most of the Nikkei. That's a bit questionable, ain't it? Great for the companies, but right. So you can see that if you have the government themselves buying its own stock just to keep the growth going, you're kind of manipulating the natural working order of a stock value. It's not exactly inside trading because, other major banks buy into it as well, but not at this level. I mean, owning shares in 90% of the companies in the Japanese 225 and being a top 10 shareholder in every single one of them, that's a big chunk. So that's why it's kind of considered like, okay, this might be a little bit of an artificial growth. They're just pumping money into it to keep it going, even though it shouldn't. Or maybe shouldn't. Right? So this is where, the volatility kind of died down, but at the same time, it's odd. But yeah, here you get a whole bunch of names that probably most of you don't know. There'll be a few that you know. Tokyo Electron, Fast Retailing, SoftBank, Daikin. The Funnet Corp is actually a really major corporation. KDDI, Advantist, Shinetsu Chemical, right? Recruit Holdings and Terumo Corp. These are the biggest ones in there. Most of these are big corporations, mother companies that kind of go under the radar for most of us in the West. But we'll just keep an eye on the top three here again. Okay. All right. So why is all this so important? Well, let's look at how to analyze an actual index. And we're going to do this step by step. So let's consider the average growth of each index first. So let's take for our example the S&P 500, right? In LegacyFX, it's listed as the US 500, and we're looking at it on the weekly schedule here. Now, what's the first thing that anybody notices? No, that's a bit too much. I mean, pretty obvious what we're looking at, right? So it's just steadily going up. It had a little bit of a whoopsie daisy. Obviously, 2020 wasn't exactly the best. And that's where you can see where that really had an effect on the whole thing. Usually you have a few bad days as well during election days, depending on who's winning, which is also funny to watch. But you can see that in general, since 2020, after that initial shock, by mid-2020, it already passed the point that it came from. Basically, what this shows you is that it has a strength that even if this was the trajectory it was doing and it dropped, the recovery rate is actually pretty good. Oops. Let's make that thicker. Right, so this was the level where 2020, when March 2020 happened, right, the February, March. It reached that level again by July, end of July. Well, August, actually. In August, it actually broke that point. So it reached it in July, but in August, it broke it. And since then, it's been continuing onwards. So if you would not have had this drop, you can literally cut this part out and paste from here, not this whole part, that's recovery. This whole part, and you can just paste it on top of this and just basically pull a straight line. So the economy just got, hit in the face, but this is the strength of those 500 companies. They're not really affected by everything. They just need a little time to adjust to the market, and they did that pretty fast. Now, since then, we can see there's a steady growth, right? Making a trend line like this is a little helpful, but obviously we can ignore basically this block over here because that's like a recovery time. So that's not part of the standard growth. And we can see here that it's basically for the first time jumped out of its reach a little bit. Anybody have any idea why this might be? Might kind of like bump down all of a sudden? Because see, this is an important question to ask yourself. That's a correction. Joe Rogan. I like that one. Rate hike speculation is part of it, yeah. But what did I say? Remember, why is it important to keep the top three in mind? Who's had a bad week? Me, yeah. Facebook, yeah. Facebook got a slap across the face. So, what ranking was Facebook again? Who remembers? Facebook is evaluated of about 3%. They're fourth, yeah. Their value is 3%. So let's actually see, right? Because you can see this drop. Now we know this. You can do something like this. Go like, oh well, this is a resistance level. Really? Based on what historical number? Don't do that. That doesn't work with indices. There are supply demand zones. There are certain pricing levels, but you have to keep in mind that inflation is a reason why markets keep growing. And that means stock markets can keep growing because they basically just climb in value with inflation anyway. Make sense? So we just have this little break. That doesn't mean the trend is broken. We're just having a pullback, which means we can do another trick a little bit later down the line when we get to the actual analysis. So what we do know is that any pullback in history, can you stop doing this? Any dump that it had in the history gets recovered, and you can go all the way back to 1960. When was it? The Beurskrach and all these kind of things. You can look at all those. It recovered from all of them. Whatever doesn't kill it makes it stronger, quite literally. And you can keep in mind, every time a market dumpster dives, like just nosedives, burns to the ground, it doesn't matter even if the number one company burns to the ground. Because guess what? That pie that just freed up, somebody else is going to take that pie, maybe a 2 or 3 companies. That pie doesn't disappear. That market share is still there. Somebody else is just going to take it. Therefore, in the market, on total value, nothing really changes, it just keeps going. It just gets, redistributed to something else. And that's what these indexes really, really show you. So we do know that we have a bit of a dip. Okay, that's fine. So what is the next step? So what is our conclusion of the initial analysis of S&P 500? Recovers from any drop, climbs steadily, even during a pandemic, right? The last 2 years, and currently has a little bit of a jump. Now we need to find out why that little bit of a pullback is, right? So what do? Well, first of all, if let's say you want to day trade, you do this as well. Every morning before you start the trade, keep in mind that it's important to know, I didn't mention that here, but obviously you don't trade it when the market is closed. I thought that needs to be obvious. You don't trade the US 500 during European times, you trade it during US times. So think about this as well in your trading schedule. If you live in Australia, it's going to be a little difficult to trade the US market because unless you want to be up at 4 a.m. in the morning, you might want to grab the Nikkei instead. It might be more your time zone. Might be not as interesting, but then you have to learn how to trade with pending orders and pre-predict market movements, et cetera, et cetera. That's risky. All right, but the first thing we do is we check the underlying stocks. Right, so the first one is the biggest one. Let's check on Apple. What's Apple been doing? Oh, great. What did I do? Oh, no, we're good. Well, what has Apple been doing? Apple things, I guess. Well, I would say Apple's had a few more bigger swings in the last few years, but overall pretty Gucci, I think. Anybody disagree? Anybody think that, no, this is terrible? If you were a betting man, would you buy Apple stock or sell it? Yeah, everybody goes buy. Yeah, of course you would buy. Unless there's something major, unless there's something really, really major, right? And I don't mean like, the CEO dies. That just means there's going to be a different CEO. I mean, the stock might drop for a little bit. Like when was Steve Jobs? I don't remember when that was. What did it drop? Like 30, 40% maybe? Something like that? I think that was a year, wasn't it? 2012, something like that? Yeah, that's like 30%. No, that's it. And then after that, okay, fine. I'd have to look up the date, but I'm pretty sure if you look up the announcement when Steve Jobs died, you can find it and you'll find a drop. It's either one of these. It's like 20, 30%. I think the stock dropped in one day. That's about it. And then it just like recovered from there. People actually started buying more Apple in sympathy. Funny how consumers work like that. But anyway, so we know Apple is having a neutral day or neutral week so far. Let's take a look at the day. Oh, today's a red day. Yesterday was a nothing day. Price action people will go like, hey, that's a pattern. Yeah, I know. We're not going to discuss that now. But even if it wants to jump down. So here you can do a little bit your analysis. Like, okay, so we have a little bit of a resistance around the 158 mark. Here you have to think more about when do people start buying the actual stock. Because people want Apple shares. People want to buy the biggest blue chip in the S&P 500. When do we want to do that? When the price is low. Trading 101, right? So you have to use your common sense. You can't just analyze an S&P 500 and then trade buys. No, you have to look at when is the good time to go in, because your short-term trade, even if you're trading an hour, what if that hour trade turns into the bottom of a massive rally? Then you trade your, intraday trade, which could have been a monthly trade that just kept growing for a month long. You have to plan in for those things. Like indices, you have to think further ahead, not just the next few hours, maybe a day. No, but you have to think about every trade that I open on an index could be a potential staying trade in my portfolio to just create stability of growth. And then you put some criteria on it on when you pull out, when it starts pulling back. Okay, so we have a little bit of a downward stay, but it's nothing compared to the previous. So it overall has been, if we take the last week or so, as we get seen here by this week, generally slightly positive, but no real movement. Okay, so that's what we know about Apple. So the next one that we're going to then look at, right? You do this just top it. You don't have to do a whole bunch of analysis because you're not buying the actual stock. If you want to trade Apple, you go further into it, obviously. But let's take a peek at what Microsoft is doing. MRFT. No, how did they have Microsoft here? Microsoft should be MRSF, something like that. This differs per broker, by the way. This should be a Microsoft MSFT. There you go. All right, so every broker, depending on the bank that they use as a handler, let's put it that way, the name might be different because the bank determines how the listing is listed. Generally speaking, like that's especially with the indexes. Like here, it's the U.S. As you can see here, the S&P 500 is the U.S. 500, and another broker is going to be SP 500. And I had one where it was called the USA Index. It depends. You just have to look for it. Just use your common sense, you'll find it. All right, so let's see how Microsoft has been doing. Well, first, this is all weekly, right? We just want to have the big picture right now first. So generally speaking, good. Little bit of a negative year so far. They've not been the greatest. They've basically been declining since near the end of 2021. So quarter one of this year is not looking too hot. Apple's kind of suffering a little bit as well. It's funny that Microsoft is suffering a little bit. For those that are following the gaming industry a little bit, you see that Microsoft is buying up pretty much every little bit of developers and companies and pulling a lot of exclusive rights to them. The gaming industry has become massive over the last 15, 20 years. It's now one of the top 3 industries in the world. So Microsoft is really investing in that, trying to get that revenue to them and doing that by exclusive deals and stuff like that. You need to also understand, obviously, Microsoft is no longer primarily focused on, obviously, Windows. That's like nothing to them now. It's like not even the top 100 company company things. It's Office packages and corporate solutions, So in order to understand, okay, so why would they be declining for the first quarter of the year? Could be that they did a very big investment run, like I just said, and that means that the solvency isn't as good as it was before. And it means that they've made a big investment and they haven't had the return yet. Once that return comes in, then investors are going to get that confidence back, because then it shows that the company made the right investment. They didn't just spend a bunch of money, right? So you have to understand that investors in companies can be fickle as well, because they want their return on investment as soon as possible, not in 20 years. Obviously with bigger companies, they kind of just sit in the money. But so if you're then now in a point of, hey, I want to trade Microsoft, Then it's important that you then do the following thing is now you start reading up for the last month, last quarter one, what's been going on with Microsoft to find the explanation why this is dropping, right? And that should be public because they're publicly listed, so everything they do has to be reported. Everything has to have a press announcement. You can just go to Microsoft corporate website and they'll have the press releases and everything. That's if you would buy the stock, but we're trading the index. So do we care why it's been dropping? Not really. All we care about is that we know it's been dropping for Q1 so far. So the number 2 in the index is having a little bit of a rough patch at the moment. However, as of 2 weeks ago, it kind of stopped declining and it pushed back up a little bit, had a dead day, so it didn't have enough confidence to push back yet. So it looks like it might go into a consolidation phase now where it's kind of like hanging around a certain price level. That's what this is starting to look like. Doesn't mean it has to be. Right? If we look at the days, we can see the last few days kind of represent that. We have an average line, if you would just grab it. So we have like an average line around the 300, 305. Now, for publicly listed companies like Microsoft, because somebody's asking, where do you find this info? Publicly listed companies like Apple, Microsoft usually have an investor version of their website. If you just go to Microsoft.com, you'll probably find for investors or corporate, and then you'll have their press releases and everything else. That's where you can find that info. You have to actually look at the company, and this is why I said follow Bloomberg, because they generally report these things as well. Kind of explaining why these things happen, but they do it as it develops and not like in hindsight. Okay, so conclusion number 1, Apple, not the hottest. Microsoft, kind of in a dead end. All right, so let's take a look at Google. Google's not having the greatest. Oh, wait, that's a week. Let's go to week. So Google, yeah, Google's still going up, doing its thing. I mean, it's hard to not do anything with Google. So they had a little bit of a pullback, but they already rallied again. And it's kind of hanging around this level. We can see here as well, like average, it's for the second half of 2021 and the start of 2022, it's kind of been hanging around this price level here of 2,800, right? So there seems to be something going on in these markets that it's kind of stalled out. Well, obviously the pandemic is part of that, but there's more to that story than just that, obviously. And the last one we'll check, you can check is Amazon and then see how Amazon is doing. But now we know that, okay, so generally speaking, it's kind of like neutral to slightly negative. So how does this help us as traders? Well, that means that right now, we know that for the S&P 500, if they are already affected like this, most likely a lot of the lower list ones are as well, unless it's specific for a specific news announcement why a company has a sell-off, like Facebook. The rest we can just see like, okay, so the S&P 500 will probably either be going sideways right now or slightly down, not up, until the other three start changing. What does that mean? That means that we are still going to be looking for possible buying moments after the market drops. So we need to start monitoring how far this rally is. Now, let's say your approach is this, right? So this is the next step. We're going to take it to the next step. But you do the same thing what we just did with the UK 100. You do the same thing with the German 40, right? Due to time, we can't do it for every single one of them. But you basically look at those top 3 companies, see what they're kind of doing. If you get like a really mixed signal, one's up, one's down, one's sideways, then look at a few other ones as well that you know are in there. You can generally just Google it and you'll get the full list of all the companies that are in it at that time by ranking. So it's not that hard to find. You can even get them with market cap if you want to know that. And then you just start looking into it's like, okay, so what are they doing? Because that gives you an understanding of what the index is doing and why it's doing it. Right? If everything is tanking, then you just know like, okay, now instead of buying, we're looking for selling opportunities. In the back of the mind, keeping like this is not going to hold for very long because eventually they always recover unless the economy completely collapses. And at that point, trading is not going to be my number 1 concern. Right? It makes sense. because then we have completely different things to worry about. All right. So the next step that you do is, well, you check the news, right? So like I said, right, Facebook, okay, let's say you go to the Facebook stock and you see this massive drop all of a sudden. It's like, what the hell? Well, check the news, right? Investing.com, Bloomberg, LegacyFX economic calendar, see if there's any announcement for the stock. Really dig into the financial news, find out why there is not a single publicly listed stock that has a dumpster day and it doesn't get reported on. You will always find out why that is. Yes, interest rate can also affect indexes, because obviously if they start talking about a bullish or a hawkish hike or a cut, then the stock market is going to react by that by stopping investing to wait until the actual number is released, even though they kind of factor it in. But they'll wait for it, and that's when you generally start seeing a few days of sideways movement until that announcement hits, and then they know like, oh, okay, we're good, and then go or react accordingly. Right? So yes, it can impact. All right, so check the news. So this is one of those things, right? Double check when the next interest rate hike is and what's the story about the central banks, right? What's Bank of America talking about? What's the Fed talking about? What's the IMF talking about? What is the Bank of Japan talking about? Considering most of it, might be important to know what they're thinking. Right? So that's your general analysis. Now we're actually going to start doing our next step. So we make our initial conclusion. The initial conclusion that we have, and we'll take the S&P 500 again as an example, is that we know that it's growing steadily up. Buying is the strong point. However, at the moment, it's moving with a less strong intent for buy and more of an intent of sideways or sell. Right? That's what we kind of could tell from the initial stocks that we looked at. So we're looking at potentially doing some sells right now. So now let's do some of the technicals to determine our entry and exit levels. Now the problem is you get this, and when you do this, well, you don't really have anything. Now you can start doing manipulation, doing like, oh, well, hey, I'll do this. See, and then I can just extract this and then I'll have a level. Is this correct? A lot of people instantly, no, it's not, because you're taking this massive drop and your starting point is, your low point is before your starting point. That doesn't make any sense either. So yeah, we just know that this is broken. So you just have to restart. We just don't know how broad this is going to be. But the last time it did it, which you can look at, is looking a little bit in the past, whoops, to get a little bit of a hint. So when's the last time it did something like this, where a little bit of drop here, it did that. So we just take this little boy and it broke through, and then you can see if we squish this, boop, which would have probably been this and then just a rally, but yeah, it was something like this, but then a rally. Wait, stop snapping into place there. Okay, do that then. Sometimes you have to fight with your charts. It's okay. It's an abusive relationship trading. So here we had a little bit of rally, then instantly corrected back in. Fine. So here it broke it, and we can see that it broke for what, 2 times the size, give or take. So this is where you could use a pitchfork, for instance. No, this is about equal, so a bit more. Here it did a little bit, but a little bit more. So here we have one thing that we can look at. It's like, well, that, but you can also do this in this case. Well, if we take our line system, for those that watched my other webinar, you know about this. There seems to be visually a little bit of a level here, a little bit of a level there. So this range is probably quite significant. Right, if we take it like this. So this range is, as long as it doesn't go through this range, we should be good. Because once it breaks that range, then we're probably talking about a big pullback rally, big pullback. So that's one thing to keep in mind. And then kind of poke through that story. So this, we're good. But by determining this level, and we have our wick here, and we have our flat lines here, we can take the bottom line out. Now, we already know our top, but that's not really relevant because there's no other top to relate it to, but we can kind of say like, okay, this is the first top that it needs to break for us. So where are we at now? We're like halfway mark. We're getting up to the previous little bump in the road there. That also had a connection with the bottom here, so we can kind of judge this. And when we break this up, you now start seeing that there is this little bit of a correlation between the two. Because if you see the previous levels where it all got stuck, these are kind of the levels. So what's something that we can use to play with this? Well, we're not going to trade on a week. So we're going to look at the day first. And in the day, you might be able to adjust this a little bit and look at this story. And if you move it a little bit up, then it's more in line with this. It's connected with that. You have a wicking here. Obviously, this is a breakthrough correction, breakthrough correction. There is a little bit of playground there. Now you can also look at price action. You can look at a few things, but let's make this really simple. Obviously, we also because of a little bit of a time problem that we have. So here we have a bunch of wicks. We have an extra connection, but I would say take the solid bet, which is the bunch of bottoms that are more connected. Here, here, here. This one touched. Okay, so what does this mean? So let's say we want to look at still. Let's say we want to look at a sell first and then take another buy. Well, there's two things we can do. First of all, we can look at what the Fibonacci is for those that followed that last time. Right, we got our full here, and this one is weird for some reason. Well, anyway, so when we get our pullback to the 68.1, which generally means that if you have to flip it around now, see, I don't like it how it does this. This should extract across the entire screen and not just like this, but whatever. So now we get a 100, it pulled back to about 38.2. So if we extract this, it would be 138.2, but that's below that level. But we don't want that sell. What we do want is the original. The other way around. Come on, work with me here. Okay, so here what we do want is to look at, usually if there is a rebound, we have this. We want to be above this line. Well, this line and this line kind of correlate with each other. Now you can say if I take it to the wick, it matches almost perfectly. Right, so if you use Fibonacci, if you don't use Fibonacci, that's fine. If you use indicators, if you use anything else, but with indices, Fibonacci is actually quite stringent because it's a self-fulfilling prophecy, because people use it so much. Pending orders and entry levels are judged based on Fibonacci levels a lot, so it kind of fulfills its own promise. So you basically are identifying where other people think that they should get in. Okay, so we know that these levels coincide. So if we would go for a sell, we already know that our stop loss should be either here, here, or way above. If we're selling. Now, who thinks it's going to be that one? Number 1, 2, or 3? 1, 2, 3. What should be the correct? If we're looking for a sell right now. Stop loss 1, 2, or 3? 1, 2, or 3? We got a 2, we got a 1, we got a 1. Da, 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 da. Okay, so there's a mix, but luckily nobody's saying 3, because I don't know why you would still hold on to a trade at that point. We're looking for a sell. The reason we, in this particular scenario, yeah, exactly. That was correct, Rabba. So when you look at the current scenario, you're looking at it had a little bit of a pullback, and it might be in a rally now, but based on the information we have right now, and let's say you already went through all the news, there's nothing coming up, so it's literally just market sentiment at the moment. then it looks like it might want to do something like this again, like a little bit of this back and forth, like repeat this pattern kind of thing. So we want to take a little bit of a sell, but it's a risky sell because we're going against the general buying consensus. So you don't want to get into a position and be stuck for a prolonged period of time. It's better to get out early in this case. You're taking a more risky position and you're underneath. You would wait for the day to close, first of all. You wait for the market to close and confirm that it closed underneath this resistance, because then tomorrow morning you will know that when the market opens, it will most likely be a red day. So, and if it's not, you can get out. And you can make the decision in the morning. You wouldn't go in now. Well, it's midday, but the market closes in a few hours. So, all right, so you have your stop loss. So if you would go in at right now, right, we now know our distance, right? So that's 4,000 points, okay? Now, the only thing is take profit levels. This is always a question. So where do you put your take profit? If we take a sell, general ruling of 1 to 3, you don't force the ratio, but you try to get it. There's 3 possible scenarios there. I can go for the halfway ground. I can go for a little bit of the retest, or I can be the one that says it's going to break that level. So 1, 2, or 3 again. This way down. 1, 2, with 3. Oh, this is a very, very uniform one. Tanya, I like yours too. Yeah, okay. So the smartest choice here would indeed be the number 2. That would work for me at least. Now you can go for 3 if you think, if like a swing trader would, like this is breaking. In that case, your trailing stop would start at 2. Tanya nailed that one. Right. So if we now have this set up, do we care about the distance between our entry and our take profit? For those that have watched other webinars, you already know this answer. Do I care about that distance? No, you don't. Nobody cares. You know why you don't care? Because I've never heard anybody complain about more money. I've heard people complain about losing though. This is going to be adjusted a little bit here and there. It's a little bit on your gut feeling where you think it's going to pull back, not the full way. Now, if you were doing the FIBO like earlier, right, and you take those 2 consideration lines in effect, you're going in. Oh, crap. No, I would just do this, will you? So we go to the 68.3, and then you see that I just moved it up a little bit, and now it's at the 23.6 line. Right? The 0 line is number 3, but that means that it has to break that resistance point, which is going to be hard for it to do. And to be honest, if it does do that, it's going to get a correction when it pulls there. So even if you go out with your trade and it starts to pull back and then go red again, you can re-enter again for a new trade, because then we probably are going to go into a little bit of a dip period. And then you get the interest rate decisions and blah, blah. All right, so now that we know, now that we know our take profit, that's fine. So the only thing that's left, right, we've decided that we want to do a sell that will eventually become a buy, because we want to, generally speaking, look for buy. Now, if you are somebody that uses indicators, RSI, stochastic, MACD, whatever it is, alligators, triple moving averages, I don't know what you use, you now cross-reference those before you enter the trade. You can do that by looking at the 1 hour chart. Right now, it's more like your execution moment. This will now tell you that it's probably slightly oversold at the moment or getting pushed. So you know that now is not the right immediate execution moment. it's probably going to pull back for a day. Like the last hour, it's going to pull back a little bit. So you can wait for that. Right. So here we get, like if you do FIBO here, you're going to get this little pretty picture. Oh, look at that. It pulled back to 68. Yay. Or it's doing the opposite direction. Well, actually it would do this, but like that's what see the 68 one line is again the exact line in the hour where it pushed on. So you can see that Fibonacci is kind of like a self-fulfilling prophecy in indices because so many people use it for bending orders. So yeah, the volume keeps shifting on those levels. So keep that in the back of your mind. And it's perfectly fine. So we also see here on the hourly chart, there's going to be a range here where it's going to get rough. And that is going to help you with the following decision. So before we open the trade, we know that this level roughly is going to be something considered around that price level. So let's say I go into the sell right now, I open it. The first thing I need to know is this distance and its value. So 8,000, and now you do your calculation. So you see here, you cannot do mini. Standard is not the same value as a standard on the euro US dollar, let's say. You can double check. It should be a micro lot. I mean a lot at first, but we'll see that in 2 seconds. And I'll tell you. So first of all, we need to calculate this. So if this is, under my assumption, a micro, then this is a $82 stop loss, give or take on a micro lot. So let's say, you have an account of $2,000, which you can already understand that indices might not be the best thing to trade, but let's say you have a $2,000 account or a euro or a pound, whatever it may be, and your standard risk is 3%. Right? Everybody with me? So that means that it's your standard risk is already at a micro lot being exceeded. Now then don't do this. Don't go, okay, then I'll still take the trade, but I'll just make the stop loss fit whatever my risk level should be. No. The chart determines where your stop loss is, period. If you mess with that idea, right, you start messing with your own trading level. So that's obviously a very, very bad idea. Right? Don't start adjusting it. So, okay, so let's take the fact that we have an $82 risk on a risky sell because we generally want to look for buying moments. Here you could fine tune your stop loss a little bit and go above that level. Right now you have the weekly resistance and then you get like the hourly resistance just above it. So even if it goes through, then it will probably bounce off of this at the end of the week. So you take this stop loss. Now we know on a micro lot we can already like just afford it. So we take that sell and we take the stop loss, we put it in place. Now we can get the value. It's 82.66, so my assumption was right. Standard is a micro lot value. All right, so you take 8,000 points, which is actually 860 pips or 830 pips, give or take, and then you multiply that by 0.10. Easy math, right? And then you can calculate the lot size. So based on whatever your risk is, let's say you have a $20,000 account and you still maintain a 3% risk level per trade, then you get out to like 800. So this would be then you would take this trade at roughly 10 lots. Yeah, makes sense. Because then the value becomes 800, which is roughly the 3%. And this is why you don't care about your take profit value, because that automatically gets filled in once you have a trade. Why can't, oh, it's this one. I'm stupid. So, and there's your trade. All right, now you can look like, hey, I make 158. So Do I have a 2-to-1 ratio? Yeah, roughly, a little bit less. And this is one of the things that I discussed in a different webinar. You're not always going to get 1-to-3. Sometimes you get 1-to-12, one time 1-to-5, once to 1-to-1, right? It's on average, you should end up with 1-to-3, but that's risk management, something else. Right, so we did the application of indicators for those that are using them. Price action I mentioned earlier, but price action, obviously, if you trade on execute on a 1 hour, you wait for the hour to complete, you cross-reference with possible price actions that you implement in your strategy, and once you get confirmation of that, you use it. Fibonacci I showed you in here. Yeah, you set it up, you check the 3162 level, see how the pullback relates to that, and you saw here that if you take the wicks in this case, it perfectly lines up, which means that people are putting pending orders on those levels. So that comes into your trading decisions. You can either join the train or just use it for your advantage knowing this. And then the last thing is we did the calculation once we knew our levels on what our lot size would be, knowing that a standard lot is the value of a micro lot. Now, the only thing that we do last is estimation duration of the trade. You can do that later. So like after you've opened the trade or after you've set your pending order. Now, if we look at the average angle of rallies, right, we're looking at this. That's, no, that one. I mean, like this one's a little bit sharper. This one, you can say it's either slow or it's sharp. But the initial drops are all the same. Right, here's like really down and then it had like a, so I would say this. This one is an angle like that. So where's the big ones? These are the big ones that really dropped, and then it usually has a consolidation phase for a little bit. And you, whoops, what did I just do? Oh yeah, it's about the same. Right, so based on that information, if you just drag and drop your line on here, and probably is actually the average if you look at all these lines. So we lock that in and press delete. You can now just follow the line and get a little bit of an idea. Wait, what happened to my take profit? Ooh, yeah, that wasn't the point, was it? Oh no, that was the point. Okay, so we extrapolate that line, and now we take this and we just follow it, and it says 34 bars, which means about 34 hours we should be there on average. You could also have a prolonged, but we know that this line is coming up where it might have a prolonged sideways movement before breaking through and then going down. What we do want to add on top of everything that we already have is obviously once the trade is here, we do not want to go back here. So the last thing that you do, and LegacyFX is empty, or MT5 works this way, 5,000 points. No, not modify. We put in a trailing stop. I know this is not perfect. For those that are manually trading all day long in front of the computer, you're going to manually set your top losses to 0 based on certain criteria. For the realistic world of people going to a job that are not going to have the time to do this, set up a trailing stop. When we know that this distance is 5,000, take a little bit less. So let's say at 4,000 points. So now this trade will automatically, whether you're at work, sleeping, whatever it may be, once it reaches this point, it will automatically move your stop loss, boom, to 0. No matter what happens, if it does get rejected here and it pulls back, it hits it. Generally speaking, you're going to want to do this based on the average daily range by calculating the last few days and see what the average candle range is. But because of the situation of where we are to the next point, you simply take the next point. If there was only the perfect scenario, so this, resistance, or resistance support, then you would calculate the average daily range and take your trailing stop on that level based wherever that roughly is, plus 20%. That worked for me. If you have a different system, use that. But that generally avoids most of the pullback ones that just nip your trailing stop and then go to your take profit. And it generally only does it when there's really a reason for it to pull back more than that. Usually a news announcement I forgot to check, or something happened, or unexpected. So these are things you need to keep in mind. Okay. Yeah. Oh, we're 15 minutes over. We started 5 minutes later. All right. So for those that are watching the recording or YouTube, I'd like to thank you all for watching. I hope it was informative. I hope this is something that helped you understand better how to approach a little bit trading indices, what they are and how to do them. Obviously, the rules that I just showed on the SP 500 apply to all of the other ones as well. The Nikkei being the only exception because of its volatility. So just keep that in mind. Other than that, I'd like to thank you all for watching and hope to see you again on the next webinar. Thank you. For the people in the for the people that are in the, sorry, I was reading something and I was trying to say something at the same time. I wish I had a glass of water right now. Yeah, so for the people that are here, that are staying, now is the Q&A session, so this is where you guys can fire away. But before you do that, I just want to point out for the people that are leaving, that are not going to be staying for the Q&A, that generally speaking, after I close the webinar, it sends out a survey. It's anonymous. Feel free to rant in it if you think it was bad. But it basically allows you to vote on what I showed you, how I presented it, just general feedback, which is, I always can help because it helps me improve, bad and good. But it also provides you with the opportunity to present suggestions of what you would like to see next. Now, I know this is the internal one, so most of you have an account with LegacyFX and you're participating with them. So this helps you, your brokers actually looking, the team behind them is actually looking to provide you what you guys want. So give those suggestions, because when we get enough of them, I can make more they'll request me to make the content for it, and I can provide you exactly the webinar you want. Obviously, there's also the thing with, for those that have it, the loyalty system. I'm still there as a reward. Sounds stupid, but yeah, you can get a private session. So that's something to look into. As for the first question, the recording is going to be sent to you automatically. Now, generally speaking, that's the next day or the day after. But in any case, it will be uploaded to it will be on LegacyFX's YouTube channel. So YouTube, and then type in LegacyFX, you'll find it. All my old recordings, all my other recordings are there as well, by the way. So the other things that I did for them. So if you are looking to learn about technical analysis, there's one webinar where I literally devote an hour on how to draw the lines and all the rules, mainly on the majors, because for most of you, and don't get this the wrong way, most of you will not have the correct capital in order to trade commodities and indices in your portfolio. You should be sticking to the majors and the minors. And this just has to do with your capital accessibility. You need to utilize this. This is one of the mistakes I made. I was trading gold and oil in an account of like 500 bucks. And obviously that blows up the account the second you get it wrong, because you have to trade this big, otherwise it doesn't work. All right, so keep that in mind. But yes, Chris, you should be getting the recording sent to you. If you don't have it by the end, by tomorrow, obviously wait until after the weekend, but otherwise double check on YouTube and it will be there for sure. Derek says, I'm not sure everything you've done. Fibonacci, use points outlay. How do you get more info on this? I'm a beginner. Derek, like I said, go to YouTube, type in LegacyFX. There's a whole plethora of webinars I've been doing for them for the last 4 months. Technical analysis, step 1, 2, and 3. So from drawing trend lines and channel points, to judging entry and exit points, to looking at price action, to setting up indicators, to using Fibonacci, to risk management, to calculating variable stop losses and why you should, how to build your how to build a trading strategy. What else did I do? Jesus, I can't even remember. I did one on crypto. Yeah, a whole bunch of stuff. Just take a look at the list. There's a whole bunch of stuff there. So Rob asks, does the same apply for like the US Tech 100, which is the NASDAQ, the Indian, and so on? Yes, all indexes and indices work in the same way. So you can use the same approach to every single one of them. Learn which the top companies are, check them before you do anything with the trade, look at the bigger picture first. What is the bigger picture doing? And then based on that, you make your decision. It happens to be that today, or the last week or so, it's been a selling opportunity instead of buy. 90% of the time when you're looking at the S&P 500, you don't even have to look if it's a buy, it's a buy. You're just looking at when is a good time to go in. Right? Everybody that, like the bigger companies that now have the S&P 500 stock in their portfolios, they're now in a down draw. But they don't care, because big guys, they don't care if they go down $500,000 worth, because they know it's going to recover within the next few months, but probably by Q4 this year, it'll be past the starting point. They still make profit. Time in the market, not timing in the market. Time in the market is always more profitable than timing in the market. The problem is we don't have the luxury of time in the market. We have to time it. So that's why we always pull on the short end of the stick. Is FIBO enough to predict the movement? No. So I just don't have time to go through all of it. But basically, like I said, you apply your indicators. You apply your technical analysis. You look at fundamental analysis. So you do your checkup on the news and everything else, like I said. And out of all those things, you get different confirmations that say buy and sell. Once they line up to all sell or all buy, that's when you have your answer. We just kind of shortcut it a little bit this time. Do you have your own YouTube channel? No, but people keep asking me to make one, so probably eventually I will. But for now, please, please just go ahead and go on LegacyFX on YouTube. So YouTube, and just type in LegacyFX and take it from there. I have to go. Thanks again. My pleasure, Rabe. I'm glad you liked it. Hope to see you on the next one. Oh, this month is going to be this one 3 times, so maybe not join this one again. But feel free to. The more the merrier. You're welcome, Chris. You're welcome, Patrick. You're welcome, Raba. You too, Patrick. My pleasure, Tanya. Does anybody have any other questions before everybody thinks like it's over? Yes, supply and demand zones do work with indices as well, but more in the sense of that there are certain price levels at which big operators put pending orders. So there are certain price levels that they won't allow it to drop below. So they have like a whole bunch of pending orders already now. For if it ever gets back to that point, we automatically buy because there's no way it's staying there. Remember what I said, right? Even if the US economy crashes, the entire pie is still the same. The people didn't disappear. The flow of money disappeared. But eventually that comes back, so that pie needs to be filled again. Somebody else is going to pick that up. Zane, one of the things LegacyFX has a, I think I'm in the, I should be. There is a loyalty program they have, and if you build up points from what I understand, and then you can claim those, and then you can request through LegacyFX a one-on-one session with me. And well, the other thing is obviously directly, but not really professional if I do that here. So, but yeah, I mean, Google is your friend. I hope that answers your question. Okay, so John asks, why is the Dow Jones or the Nasdaq not on your list of important indices? It's not. It is. The only reason I didn't put it in here, as you can see, we already went 15 minutes over. I have a limited amount of time, and in 1 hour, to really cover everything. But obviously, if you're going to do indices and you want to focus on US indices, then you don't have to stick with the S&P 500. Yes, maybe the most stable one, but it's not necessarily the only one. What you can do is like, okay, I'm more familiar with tech, or I have more feeling with tech. Then obviously you trade the NASDAQ instead. Now, if you want to trade the Dow Jones, then you trade the Dow Jones, right? It's the same concept that applies to all of them, the same approach, except the Dow Jones and the NASDAQ are specific market segments. So they're not US market related in the big sense, but they are a specific segment of that market. So if you have, let's say you work in that segment, yes, of course, you would trade the Dow Jones if you work in that segment because you are already informed of what's going on. So it helps you make your decision. So absolutely, Dow Jones, Nasdaq, they're all in my important indices to include. But due to time pressure, I can't cover all of them in one webinar. Because then I would just do the U.S. indices. That would be one webinar, and then go over the Dow Jones, the Nasdaq, and But yes, no, good point. Thank you. Hope that answers your question. Oh, it did. Cool. Where can one learn more about panels, like when candles are going to keep going into a direction or trend, reversals, etc.? Glenn, YouTube, LegacyFX, webinar I did on price action. I explain a few of them and how to identify them. Other than that, from there, if you want to learn the more advanced ones, you're going to have to go into just looking up education on price action, really. There's so many candle patterns, and some are stronger than others. Like I did the other week, what was it? Technical tools to use, I think was the title. But I covered things like grid trading. I covered things like Elliott wave principle and stuff like that. Like Elliott wave is one of those things, everybody's heard of it. No, nearly a lot of people understand it, even less master it. But the biggest problem is that it's so open to interpretation when something is an Elliott wave and when it isn't, that a lot of traders just don't pick it up because there's just too much of gray area. It becomes own perception. But then, you also have martingale strategies and stuff like that, which require capital. And all right, so there's a lot of different ways you can trade, a lot of different ways you can go about things. But candle patterns, price action, there's a few patterns that you can just back test and see that every time your US dollar does a rising star, it always follows suit correctly, or 90% of the time. So if you get that confirmation as a candle, and it could be in a day, it could be in an hour, it could be in a week, you have to check at what point that price action is most accurate. But you can do that by backtracking. Yeah, well, by backtracking, you learn how to spot fake outs. And you're not always going to predict all fake outs. Sometimes they're going to get you. But this is the thing. Losing isn't bad, guys. It's part of trading. If you take something and trade it every single time it happens, and 70% of the time it does the right thing, that means that 3 out of 10 trades you lose, but you're winning 7. And if your risk management is right, you could not care less about the 3 you're losing. You're looking for consistency. You're not trying to be a 99% win rate like trading bot. That's for social trading platforms. Look at my win rate. No, I care about your risk management because I'd rather not have you blow up the account. I'd rather you take a loss when it's reasonable to take one. Anyway, this is just me ranting. What do you think is a good time to buy U.S. indices now, or what? So Jerry, like if you saw how I calculated U.S. like today, generally speaking, you're looking at certain price levels where it dipped out before. That's where you want to buy in and for the long run again. Right now, it looks like it might be moving sideways into a buy, into a sell, and then flip into a buy again because a little bit the news that's going on in the market. We didn't go into all that depth because we just don't have the time. But what is a good time? Well, generally speaking, 90% of the time, the S&P is a buy. If you look at the day trade, just look at a day chart and count the amount of green candles versus red candles. Most of them are green. When it dips, and then you just wait for it to stabilize, and then you can just wait for that, and then once it starts moving up, just start buying again. This is generally how the S&P works, and this also works for the DAX. This also works for the FTSE. It doesn't work as well for the Nikkei because of the reasons that I explained. It's a little bit of an oddball. Like it can just like dumpster dive from 30,000 to 7,000. Like I'll show you. So this is the S&P 500 on a weekly chart. And now we compare that to this. Like, so this is the Japanese 225. And this is the S&P 500. Notice any difference? You don't notice any difference. All right, take a look again. Follow my cursor. Up, massive drop. Up, stabilized all the way back to the start. Up, back down. The US, little decline, Great Recession, 2008 after effects actually. Climb, a little bit of a drop, climb, 2000 pandemic start, recovery. Now we zoom out. Like this is the pandemic. Other than the pandemic, Trump, you generally have nothing. It just goes up. The FTSE, nah, this rating doesn't start till 2017, but you would go all the way down and then see it go up. Same drop, March 2020, they're all going to have that. German 30, March 2020. Look at this drop. It went back to levels of 2013, and by the end of 2020, it was back at the level that it dropped from. This is how strong these indices are. So when something like this happens, every single fiber in your bone should be yelling, I got to buy this thing the second it stops falling. Right, so this is, keep that in mind. Okay, because inflation is higher and next month Fed is looking to hike interest rate, which will put pressure on the industry. What is your view based on this? I don't want to get too much into prediction mode here, but the reason I just buy the US is because I think the markets are going to get a little bit of a knee-jerk reaction and go like, ah, so it's going to basically start selling off a little bit for safe environment purposes, let it level out, then the hike, if confirmed the hike goes through, then everything will rocket back up to where it came from. Like, okay, good, we're good to go. Inflation being a little bit higher is not the end of the world. Inflation is something that hits, what's a good word for this? The working class more than the others. Because, okay, so in the US, companies should match inflation or salary with inflation rate, right? They don't always do though. So the people that suffer from inflation are the majority, the working class. And don't get that the wrong way, as working class being negative. I'm the working class. Like, we feel it. You know, I don't think somebody like Elon has a whole lot of problems with 3 or 4% difference. I don't think it really keeps him up at night. Are individual stock is important to track for an overall picture, world of the indices? Yeah, Yanis, this is exactly what I did. So we took the S&P 500 and we looked at the top 4 or 5 to see what they were doing today. Because if you're going to day trade it, the most important thing is to know what the bigger stocks, let's say the top 10, are doing. Because if the top 10 is negative, you can assume that most of them are going to be negative. Ergo, you're going to have a red day. So you're going to be looking at selling. If most of them are green, then you're going to have either a neutral day if they're 50-50, but then it depends a little bit on the which ranking they have. But if the top 3 are green, number 4 and 5 are red, and then the rest is green again, then you're just going to have a positive day. So you're looking for buying opportunities. Vaccine. Now, Yakov, yes, you might be saying that you're kidding, but yes, losing is part of the game. This is any trader needs to learn to accept losing is part of it, and it's perfectly okay. You're gonna have shit months. You're gonna have months that no matter what you do, you just can't seem to get the right trade. It happens. Sometimes what it means is that you just need to just skip a week, like literally, just turn the damn thing off and just forget about everything financial. Just reset and come back. Like whatever it is, something is screwing up your decision making from before. Take a break, come back, fresh eyes. This is just a trick. We all have this. No matter how experienced you are, you're gonna have a shit day sometimes. Okay, Glenn has a good one. Okay, so wouldn't it be easier for you to build an EA with all your knowledge and then we don't need to take months or years to learn everything? I love the little smile at the end. Um, yeah, but it defeats the purpose. See, the whole approach that I have in my mentorship and in these things, I traded in a certain way that worked for me. I hate signal trading. I hate copy trading. And the reason for that is that I followed it before copy trading was a thing. And I saw the upcoming of things like Zulu Trade, Toro. I've seen the top traders. I've seen who comes high in the ranking. I've tracked all of it. I've seen the accounts. I've worked for a company that was with the development of Zulu Trade. I I know exactly how these things are built up and how the top rankings keep shifting and why, because we can see the accounts. It just doesn't work. You need to learn to trade. And when you learn to trade, when you understand why you make certain decisions, it learns you how to judge consistency, how to go like, it's okay if I lose 2 months out of 12, because I know that 1 month of profits, half a month of profits covers the 2 months of losses that I run into every year. And that means I have a consistently profitable account. And now you're talking about investing. Now you're talking about trading. You're growing. And it needs to be in a trading style on things that work for you, that you're comfortable with, that you enjoy, that you seem to work with. It is a little bit between the ears because obviously the chart couldn't care less what you're trading. But some people have a better click trading pound yen, which was my abusive girlfriend, and other people have a better relationship with euro US dollar, with the thing that I hate. Like I cannot stand it. It's the most boring thing ever for me. But pound yen was like one day she makes me happy, the other day she slaps me across the room. No, that was when it was still volatile. Now it's slow. But right, it's everybody has their thing. And everybody has their personality, and traders have personalities in their trading as well. So if I learn you the tools so you can make decisions yourself, you'll become a much better trader and become long-term profitable, and not, hey, I made some money today, but next week I blew up my account because I did something stupid. Or I just followed every single thing he did and he had an off day, but I forgot that his capital is a little bit different than mine. So his off day was completely different to my off day. Right. Um, it it's the concept of give a man a fish, he will eat for a day. Teach him how to fish, he'll feed himself for the rest of his life. That's the idea. I think that's the easiest comparison. I hope that answers your question, Glenn. Or Glenn, sorry. Do you think the stocks will crash this year because of all the apartment housing market, etc.? So, okay, so this is really predictive stuff, and I don't want to say anything, and people will come back like, "Ha, you were wrong," um, or you were right, like I was with Bitcoin the first time. God, people were pissed on that one. I don't think this year yet. There's still a lot of It's starting to become a red flag for me in the sense that everything is lining up exactly the same way it was 2008, but with different players. Like they're doing the same dumb shit again. Keep pushing, keep manipulating, keep pushing, duct taping. Eventually, that's going to stop working. And then everything is going to reset and we do the whole dance again. So will it happen this year? Yeah, it could, but I don't think so. I think for it to happen, you need to have rotation of capital, which is not there right now. You need money to be pumped into the market. And unfortunately, the big people aren't the ones doing the pumping. It's a little bit from everybody that is the pumping in the economy because they're the between parentheses suckers that spend money on stuff while the other guys just wait back for everything to blow up and then take benefit of everything being blown up and get it cheaper. So like I said, I don't think just yet, but it could. I think we got like another 2 years before we go into another 2008 recession kind of style. I hope I'm wrong on that one, but the answer to that question, Yakov, is private. The question was about what mentorship is. I work with LegacyFX for the webinars, but I am a personal entity, sort of speaking. I just make the webinars for them. I don't work for them. I'm not on contract with them. I am in their loyalty program, obviously, for webinars because people were asking for it. So I told them it's fine. It's kind of like getting a mentorship for an hour on a topic you want. Some people took it. One of them's here tonight. Copy trading is boring. Come on, the fun is to do the game yourself. Yeah, you're right, Tanya. I agree with you. Why would you ever want to sit back and watch somebody else do your shit? Do it yourself. Yeah, Yakov, there's another. Okay, so Yakov says, like, okay, how do you apply to it? I want to become a full-time trader. Be careful what you wish for. A full-time trader, you want to go ahead and become a professional trader, meaning that you get on a payroll at a trading company and you do PAM accounts. You do not become a full-time trader and just trade your own money because I will guarantee you, I tried that, and in 2 years I aged 30. Because 1 month you might pay the bills and the next month you might have absolutely nothing. It is the most stressful shit ever. Because if the market is not moving, you're not making any money. So this is why even the successful traders just have a day job or they trade for a living by being professional. I don't have that license. You're Series 7, Series 5, I think it is. Oh, whatever. But yeah, you get registered with the SCA, you get registered with the Trading Association if you're in the US, and then you can trade other people's money under license, under power of attorney, and then you do it that way. But that would be the route if you want to become a full-time trader. Generally speaking, Forex trading is a part-time hobby kind of trading. And yes, it can work. I mean, I'm proof of it, but for most, it doesn't. That's also something that needs to be said. Like, there's a reason that nowadays on all brokerages in Europe, they have to have that statement at the bottom of the website, what percentage of people lose their money. And I know this is a negative thing to talk about, but a lot of people trade without knowing how to trade or taking the time to learn. They just gun ho. It's like, put everything on gold because it's a buy. I've seen people make account after account after account. There was one person that I knew that I ended up calling. I was working for a broker at the time. I ended up calling them and begged them to stop putting money into his account. He was literally putting in 10K every month and just blowing it up. For the question is how you apply to like this legacy FX what do you call it? The loyalty program stuff. I'm going to send an email to everybody. Webinars@legacyfx.com. Send all. So there's you now have an email that I sent to everybody. Can somebody please confirm you just received a message from me with an email address? Yes and no. Webinars@legacyfx.com. Did everybody get that? Perfect. Thank you, Tanya. Robert, okay, you got it as well. Jakob, you didn't get it. Okay, let me send it to you privately then. Webinars@legacy. Wait, why didn't everybody get it? Okay, I'll do it again. Hold on. LegacyFX.com. Send to all. Do you guys get it now, or I'm sending it privately as well for those that say no. You should have it now. So any questions you have about policies, about accounts, about the loyalty program LegacyFX has, just ask LegacyFX, because obviously, as I don't work for them, I work with them. I don't know. You'd have to ask the company itself that, because I'm not going to tell you something and then they tell you, no, that's not true. Like, well, the company can answer its company questions. I think that'd be the best course of action. Oh, good to know. Thank you, Daniel. All right, there's still no email, Zane. I sent it to you directly. Check the chat box. You should have an email, webinars@legacyfx.com. On the chat, you should have an answer. Anybody? Yakov has it. Okay, good. You got it. Okay, good. Right. All right. Well, we're overextending a little bit. Okay, so does anybody have any final questions? I'm gonna take that as a no. Then, in that case, I would like to thank everybody again very, very much for staying. I hope that tonight helped you out. You learned something. Good to see some of you again. As I said, this month is going to be just this webinar on 3 different occasions. So this is it for this month for you guys. You're obviously more than happy to join it again. You might get different questions during Q&A. Other than that, every month we do 3 webinars. Now, usually the second week of the month is going to be the one for people for Legacy that are in LegacyFX. So if you want to join again, keep an eye on that. If you communicate with an account manager, if you have an account manager assigned to you, just ask them about the webinars. He will tell you the second that the new webinars are planned, what the date is for the new one. And I think they announce it on their site as well, or you get an email, I think, something like that. But yeah, if you have an account manager, just poke him or her or it, whatever it identifies it. Okay, having that said, everybody remember the survey, please, because it really helps me both improving my content and just myself as presenting. Both negative and positive. I love positive, obviously, but negative is positive criticism. And suggestions. If there's some specific topic that a lot of you want to see, then if there's enough requests for it, then LegacyFX will request me to make it, and then you will get it. That's simple. So the power is with you, people. So other than that, I wish everybody an extremely pleasant day, evening, midday, wherever you may be. And I wish you all the best. And as always, trade safe and trade smart. And see you on the next webinar. Cheers.